November 2023, Beijing. Inside a closed conference room in the State Council compound, there are no cameras, no journalists, no podiums with flags. Only the top executives of China's biggest state-owned giants, the national oil companies, the huge policy banks, the financial institutions that quietly control trillions of dollars in overseas assets. On the table lies a short, dry, technical document. It has no slogans and no dramatic language. But its impact is potentially greater than any missile test or naval exercise. It is an order. Within 3 years, every major state-owned enterprise must unwind its exposure to Western capital markets. No exceptions, no debate, no press release. The instruction is simple but staggering. Chinese firms must gradually exit U.S. and European stocks, bonds, real estate, and private equity. The deadline, November 2026. On the surface, Wall Street still hums as usual. The Nasdaq ticks higher. Asset managers in New York and London continue to treat Chinese money as sticky capital, long-term and dependable. What appears to be true is soothing. This looks like risk management, just another round of portfolio diversification in a tense geopolitical environment. Commentators talk about decoupling and de-risking as a slow, manageable process. The underlying story is that China is too deeply tied to the dollar system to rock the boat. But the reality is very different. This isn't a suggestion from risk officers. It's an order from the Communist Party's central leadership applied to roughly $8 trillion worth of Chinese institutional money parked across Western markets. It is not about smoothing volatility. It is about pulling ammunition out of the other side's gun and loading it into your own. In the 24 months before that order, Beijing had already been reshaping its entire external financial posture. China reduced its U.S. Treasury holdings from over $1 trillion to under $800 billion, while steadily building up its gold reserves and strengthening the CIPS payment system as a partial alternative to SWIFT. At the same time, it signed currency swap deals and local currency trade arrangements with dozens of countries, from Russia to Brazil to Saudi Arabia, creating a growing network of commerce that does not rely on the dollar. On the surface, this still looks like a China that needs the dollar as much as the dollar needs China. But beneath that surface, China is slowly constructing a parallel system designed to let it survive and even exploit a future where dollar dominance is shaken. In 1914, Germany's quiet financial strategy helped set the British pound on a long path of decline. The question for the 21st century is not whether major reserve currencies can fall. History has answered that. The real question is whether China is now running a more sophisticated version of that playbook, this time with the U.S. dollar in its sights. To understand what China is doing, start with where it sits inside today's system. From the early 1990s through about 2010, the U.S. and China built a level of mutual dependence the world had never seen before. The U.S. opened its market to Chinese exports. American companies shifted entire supply chains to Chinese factories. In return, China accumulated enormous trade surpluses and foreign exchange reserves, mostly in dollars. China became both the world's factory and one of America's largest creditors. At its peak, Beijing sat on about $3 trillion of foreign reserves, with a huge share in dollar assets, treasuries, agency bonds, dollar-denominated securities. To a lot of policymakers, this looked like a win-win. America got cheap goods and stable financing. China got jobs, growth, and a path out of poverty. However, the reality was that this arrangement embedded a deep strategic paradox. The very reserves that made China appear financially powerful were held in the currency and under the legal reach of its main geopolitical rival. Washington could, at least in principle, freeze or constrain those assets through sanctions and financial measures, as it later did to Iran and Russia. At the same time, China's holdings were so large that any attempt to dump them quickly would hurt Beijing almost as much as it hurt Washington by crashing the value of what China still held. For Chinese strategists, the Russia sanctions after 2014, and especially the freezing of Russian reserves in 2022, turned theory into a bright red warning. Dollar and euro reserves were no longer unquestionably safe assets. They had become potential hostages in any future confrontation. Meanwhile, the United States was drifting into a fiscal position eerily familiar to students of past empires. Federal debt climbed past 100% of GDP, then toward 120%. Total debt moved into the mid-$30 trillion range. Annual interest costs crossed the $1 trillion mark. The dollar remained dominant, but the structural pressures under it grew heavier every year. From Beijing's point of view, this wasn't just a problem, it was a historic opening. If China could design an exit from dollar dependence without blowing itself up in the process, it could both reduce its own vulnerability and accelerate the erosion of American financial hegemony. That is why, between roughly 2010 and the mid-2020s, China shifted from simply playing the dollar game to quietly building the architecture of an alternative. China's first problem was the classic rising power dilemma. To grow quickly, it had to plug into the existing Western-led financial system, which meant accumulating the dominant reserve currency, dollars. But the more deeply it plugged in, the more vulnerable it became to that system's politics and crises. In the years after joining the WTO in 2001, China's exports to the United States surged. Surplus dollars poured into the People's Bank of China. By the early 2010s, foreign reserves stood around $3 trillion, a huge portion of them parked in U.S. dollar assets. U.S. Treasuries were the core, liquid, seemingly safe, and easy to buy in bulk. On paper, this strategy worked beautifully. China delivered double-digit GDP growth in some years. Hundreds of millions of people moved out of extreme poverty. Cities like Shenzhen and Shanghai transformed from industrial backwaters into high-tech hubs. Keeping reserves in treasuries looked sensible, even conservative. Treasuries were the foundation of global finance. What could be safer? But there was a problem. The 2008 financial crisis revealed something crucial about the nature of that safety. The Federal Reserve could create trillions of dollars in new money to bail out the U.S. financial system, effectively diluting the value of every existing dollar claim, including the ones China held. The U.S. didn't do this to target foreign creditors. It did it to save itself. Yet from Beijing's perspective, the message was clear. Your wealth is ultimately subject to decisions made in Washington, for Washington. Over the next decade, Washington added another layer: sanctions as a primary policy tool, cutting Iran off from the dollar system, freezing assets, threatening secondary sanctions on banks that didn't comply. When Russian troops crossed into Crimea in 2014, and especially when they invaded Ukraine in 2022, the full power of the dollar system was turned into a blunt geopolitical weapon. Russian central bank reserves were frozen. Major banks were cut off from SWIFT. The message to any country on America's wrong side was unmistakable. From Beijing's vantage point, this turned a theoretical risk into a hard constraint. Dollar reserves and Western financial exposure were no longer just an economic asset. They were a strategic liability. In any serious confrontation over Taiwan or the South China Sea, similar tools could be used against China. At the same time, China's sheer scale made it hard to simply walk away. Dumping $1 trillion of treasuries overnight would hammer U.S. bond prices, but it would also hammer the value of what China still held. Beijing was too big to exit quickly and too exposed to feel secure staying in place. The initial strategy, use the dollar system to get rich, was rational given the information at the time. But as the system evolved, that rational choice turned into a trap. To escape, China needed more than just selling some treasuries. It needed to construct an entirely new set of pipes for global trade and finance so that when the time came to pull back from the dollar, it would have somewhere else to go. Instead of simply accumulating more U.S. debt, China began a careful pivot, using its dollar surpluses to build infrastructure, institutions, and relationships that would, over time, reduce the world's dependence on the dollar and increase its dependence on China. Instead of just buying treasuries, Beijing launched the Belt and Road Initiative around 2013. Hundreds of billions of dollars were pledged for ports, railways, power plants, and pipelines across more than 150 countries. The projects varied in quality and intent, but they all shared a common thread. They tied foreign economies more tightly to Chinese finance and Chinese trade. Instead of relying solely on Western-dominated institutions like the World Bank and the IMF, China created its own multilateral bank, the Asian Infrastructure Investment Bank. Its membership quickly grew to over 100 countries, including U.S. allies in Europe and Asia. Loans from these institutions often came with fewer political strings attached than Western loans, and increasingly with options to settle in currencies other than the dollar. But the core of dollar power is not just who lends, it's who clears and settles payments. For decades, SWIFT and Western correspondent banking networks have been the central nervous system of global finance. China's response was to build CIPS, the cross-border interbank payment system. At first, it seemed minor, a niche tool, but transaction volumes rose steadily. By the early 2020s, CIPS was processing the equivalent of tens of trillions of dollars a year in yuan-denominated payments, and growing fast. Alongside these institutions, China pushed a dense web of bilateral currency swap agreements. Central banks from Asia to Latin America signed deals allowing them to draw on yuan liquidity directly from the People's Bank of China. Trade partners began experimenting with settling deals in local currencies, linked through yuan swaps, instead of routing everything through dollars first. Meanwhile, Beijing quietly shifted its reserve mix. U.S. Treasury holdings drifted down from over $1.2 trillion to under $800 billion. The pace wasn't panicked, it was systematic. At the same time, official gold reserves climbed, and unofficial estimates suggested that China's true gold holdings might be far higher than reported. Instead of X, that is, passively accepting the dollar system as permanent, they tried Y, treating that system as something to be used while it remained convenient and steadily hedged against as its vulnerabilities multiplied. They did this because every major precedent, from Britain's loss of currency dominance to America's own overuse of sanctions, suggested that no reserve currency stays untouchable forever. What they didn't realize, many policymakers in Washington and Brussels, was that this wasn't just risk management. It was the construction of an escape route. Belt and Road projects created trade flows that could, in theory, be invoiced in yuan. AIIB and other Chinese-led institutions could recycle savings outside dollar channels. CIPS created technical capacity to move money around the world without touching SWIFT. By the early 2020s, the skeleton of an alternative order was in place. It was smaller than the dollar system, to be sure, but it was real, it could be scaled. And with each additional swap line and trade agreement, the political cost for countries to say yes to Chinese terms and no to Washington's got a little lower. At this point, China reached the hardest decision of all. It could continue to live inside a system where the dollar sat at the center and accept being permanently constrained by that fact. Or it could take the riskier path, deliberately accelerating a shift away from the dollar, even if that meant short-term turbulence. The directive in late 2023 to divest state-owned enterprises from Western markets within 3 years was a clear sign that Beijing had chosen option 2. It wasn't a rhetorical shot across the bow, it was a concrete timeline. Roughly $8 trillion in overseas holdings now had a countdown clock on them. And that's when everything changed, not yet in visible price action, but in structure. Those assets became latent sell pressure on a scale markets almost never have to digest. Even if the actual sales are staggered and masked through intermediaries, the direction is set, out of Western paper, into something else. The most plausible scenario, if China follows through, involves three coordinated moves. First, a deeper reduction in U.S. government debt holdings. If Beijing were to unload the remaining $700–800 billion of treasuries aggressively, yields would spike. The U.S. government would face a brutal choice: let rates stay high and risk a severe recession, or step in as buyer of last resort with newly created money, undermining confidence in the dollar's long-term purchasing power. Either path weakens the currency's aura of risk-free safety. Second, a controlled supply chain squeeze. China doesn't have to shut off exports entirely to cause pain. It dominates key stages in the production of rare earths, solar panels, battery components, active pharmaceutical ingredients, and a long list of intermediate goods. By tightening export controls, slowing approvals, or citing environmental reviews, Beijing can create targeted shortages that ripple through Western manufacturing, raising costs and fueling inflation. Third, and most strategically elegant, it can offer a lifeboat at the very moment it rocks the ship. That lifeboat is a yuan-centered financial ecosystem, cross-border settlements through CIPs, trade invoicing in yuan, and potentially a greater role for a digital yuan in cross-border payments. For countries already chafing under dollar sanctions or squeezed by dollar-denominated debt, the offer of an alternative payments and credit network will be hard to ignore. The emotional climax of this story, if it plays out, will not be one single Black Monday headline. It will be the slow, dawning recognition in Western capitals that almost every major Chinese move of the past 15 years fits into a coherent pattern: reserve accumulation, infrastructure projects, alternative institutions, swap lines, gold purchases, digital currency experiments, and finally the $8 trillion divestment order. Each piece amplifies the others. It was not a random drift, it was a strategy. And for Americans, the uncomfortable question becomes, how do you respond when a rival has spent decades preparing not to win a shooting war, but to make your currency and your financial model the weakest point in your armor? In the short run, if China continues down this path, the consequences will hit markets first. Over the next few years, as Chinese capital quietly retreats from Western assets, valuations that depended on cheap, abundant foreign money will come under pressure. Commercial real estate in global cities, highly leveraged corporate borrowers, and parts of the stock market that thrived on low rates and constant inflows could all feel the strain. If this coincides with heavier Treasury selling, the U.S. will face a stark test of how much its fiscal position depends on foreign patience. In the longer run, over 10 to 50 years, the implications go far beyond market volatility. The dollar does not have to die to lose its singular status. It can simply slide from being the reserve currency to being one of several. In that world, American policymakers lose the ability to run large deficits indefinitely without worrying about funding costs. The exorbitant privilege of borrowing in your own currency at low rates while exporting inflation to others becomes harder to sustain. Globally, the shape of power shifts. A more fragmented reserve system, where the euro, the yuan, and possibly other regional currencies play larger roles, means that sanctions become less effective, capital flows less predictable, and financial crises more complex to manage. This teaches us that monetary dominance is not just about military might or total output. It is about who builds the plumbing of global finance and whose liabilities the rest of the world trusts as ultimate settlement assets. Britain lost that position in the 20th century. The United States inherited it. Now China is openly and methodically trying to bend the next century's plumbing in its direction. The modern parallels are hard to miss. The pound's old imperial network of trade and finance echoes in today's dollar-centric architecture. The IMF, the World Bank, SWIFT, global banks headquartered in New York and London. Just as that older system eventually gave way when its political and fiscal base weakened, today's system will face similar tests as U.S. debt grows, domestic politics polarize, and rivals build alternatives. However, the reality was never going to be a simple story of China wins, America loses. Beijing faces its own formidable challenges: slowing growth, an aging population, a fragile property sector, political risks, and the possibility of backlash from countries wary of swapping one dependency for another. The emerging order is more likely to be contested and messy than neatly bipolar. The tragic irony was that for decades, elites in both East and West liked to believe that deep trade and financial ties would make serious conflict unthinkable. Instead, those ties have created precisely the leverage needed for economic warfare on a world-changing scale. But nobody saw it coming is no longer a credible excuse. The pattern is visible. The moves are on the record. The timeline is not hidden. The real question now is, what do you as an individual living inside this system do about it?